Alright, just to warn you before I start, my kids and I, we are outside, so if you hear screaming, just kind of ignore it. Alright, we are covering 8-2. 8-2 is income taxes, which, oodles of fun. These notes are kind of different. They're more fill in the blank just because there's a lot of information in this section. So starting right off, income tax is a percentage of your income collected by the government. I don't know, do you need all of that to fund its services and programs? I don't know if you really need to see the whole page because I'm sending you this or not, but we'll do it this way. Tax revenue pays for our national defense, fire and police protection, road construction, schools, libraries, and parks. The IRS stands for Internal Revenue Service. Its function, there we go, sorry, I keep moving. Its function, it enforces the federal laws and collects taxes. So from there, moving on from your definitions, your total income for the year is also called your gross income. This includes wages, tips, interest, or dividends from investments, unemployment compensation, profits from a business, rental income, and even game show winnings. To calculate your adjusted gross income, you do gross income minus adjustments. Your adjustments are considered retirement accounts, tax-deferred savings plans, interest paid on student loans, and alimony payments. Whoop. Sorry, the wind's kind of getting wonky here. So again, adjusted gross income equals your gross income minus adjustments. An exemption is a fixed amount on your return for each person supported by your income. Now, we'll get more into this. Where did we get into this? We get into this at the bottom. You've got what are called standard deductions and itemized deductions. A standard deduction is a lump sum amount that you can subtract from your adjusted gross income. Every single classification of person that is filing for taxes has a standard income, whether you are single, married filing separately, you've all got standard deductions. Your itemized, however, are deductions you list separately if you have incurred a large number of deductible expenses. These include interest on home mortgages, state income taxes, property taxes, charitable contributions, medical expenses in excess of 7.5% of your adjusted gross income. So when we're talking taxes, you want to lose the least amount of money possible. So when it comes down to standard versus itemized, you pick whichever value is larger. Your taxable income. Hey girls, can you, not? Taxable income is figured by subtracting exemptions and deductions from your adjusted gross income. Sorry, I got close there. So your formula is taxable equals adjusted gross income minus exemptions plus deductions. If you want, because I know the equations are going to be a lot. Where did my pen go? That's not a pen, that's a pencil. You can, and the cap's on, even better. You can either star these formulas that you need or highlight them or do something because you're going to keep coming back to these. So. Here we go. A single woman earned wages of $87,200 and received $2,600 in interest from a savings account and contributed $3,200 to a tax-deferred savings plan. She is entitled to a personal exemption of $3,800 and a standard deduction of $5,950. The interest on her home mortgage was $11,700. She paid $4,300 in property taxes and $5,220 in state taxes, and she contributed $15,000 to charity. So first things first, you have to determine her gross income, and it tells you all the way back up here. Your gross income is what you get paid, but it also includes wages, tips, interest on dividends from investments, unemployment compensation, profits from a business, rental income, and even game show winnings. So we come back down to our problem. She earned $87,200, but she received $2,680 in interest from a savings account. Well, that has to go into your gross. So for your gross income, we're going to do her wages plus the interest from a savings account. So add those two up and you get $89,880. Did I say that right? 89,880. That is her gross income. Now you have to find her adjusted gross income, which for the most part, I'll try to abbreviate AGI because writing out adjusted gross income takes quite a bit of paper. Your adjusted gross income, and again, we go back up here, is gross income minus adjustments. Whoop, 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 where we go? Your adjustments are retirement accounts, tax-deferred savings plans, interest on paid on student loans, and alimony payments. No. So her adjusted gross income is going to be gross income minus her tax-deferred savings plan, which she had $3,200 in her tax-deferred savings plan. Oh, hey, it's right there too. So subtract those two values, you get $86,680. Then, step C, you have to figure out her taxable income. So what portion of what she brought in this year can you actually tax? Taxable income, which is this formula here, adjusted gross minus your exemptions plus deductions. And remember, those deductions, we have to figure out if we're going to use standard or itemized. So her adjusted gross income was $86,680. We are subtracting. It told you in the problem, she has a personal exemption of $3,800. So that value is automatically brought in, plus deductions. It also tells you in the problem, she gets a standard deduction of $5,950. So we're going to come over here, deductions. Is standard or itemized larger? Her standard is $5,950. Her itemized, remember, itemized includes interest on home mortgages, state income taxes, property taxes, charitable contributions. It contains a lot of information, and she's got a lot of that. She's got, interest on her mortgage, property taxes, state taxes, and charitable contributions. So when you add those together, do you see that value? Do you see how $36,000 is considerably larger than $5,000? So we're always going to subtract the larger amount. So we're going to take this $36,220 and we're going to put that in for our deductions. So back over here, you can, if you really want, you can add these together in the parentheses and get this and then subtract. Or you could just do 86,680 minus 3,800 minus 36,220. It is completely your preference, but her taxable income is $46,660. So that is all she's allowed to be taxed on, which, compared to her original, what was it, 89,000? I'd rather be taxed on 46 than 89. So moving on to the next page, maybe. Give me a second. All right, so tax credits. Tax credits are sums of money that reduce the income, there we go, tax owed by the full dollar per dollar amount of the credits. To calculate your federal income tax, first you're going to determine your adjusted gross income, which is, gross minus adjustments. We've done that. Then you're going to determine your taxable income. Your taxable is adjusted gross minus your exemptions plus deductions. We literally just did that. And from there, you're going to have to run your tax table, which that's not a step listed up here, but we'll get to that in an example too. And then you have to determine your income tax. So your income tax is your tax computation, which is, this table, minus any tax credits that you may have. Not every example is going to have tax credits. This first one doesn't have any, so that's good. Do you see this table? This big wonking table? If you have access to a printer, you may want to print that out. Sorry, I keep hiccuping this morning. You may want to print it out to keep track. Where did my pencil go? Good Lord, I'm a mess this morning. You may want to print it out to have reference. You don't have to, but it might be easier for you. Otherwise, you're going to be flipping back to this page a lot. So, moving right along. All right, use the table to calculate the federal tax owed by a single man with no dependents whose gross income, adjustments, deductions and tax credits are given as follows. I don't know why I said tax credits. I was supposed to say and credits. His gross income, $40,000. His adjustments, $1,000. Deductions, $3,000 for charitable contributions, $1,500 for theft loss, and $300 for the cost of tax prep. Tax credits, none. So first things first, you have to find the adjusted gross. And if you need to, come up here. Adjusted gross is gross minus adjustments. Well, his gross was $40,000. His adjustments were $1,000. So you do $40,000 minus $1,000 to get $39,000. That's his adjusted gross income. Now you have to find his taxable income. Taxable, again, is adjusted gross minus exemptions plus deductions. So, adjusted gross minus exemptions. If you come up here for exemptions, we're dealing with a single man, no dependents. So coming up here, see how this says single? That's what we want, single man. Go down here. It tells you exemptions per person. So that's $3,800 per person. Well, this is a single man with no dependents. So he just has, $3,800. Plus his deductions. What we have to figure out is whether standard or itemized is larger. His standard deduction, come back up here. We're in that single column. Come down. Standard deduction is $5,950. Is standard larger or is itemized? Itemized means you add up all of the deductions listed. So $3,000 plus $1,500 plus $300 gives you $4,800. Well, which of these is larger? Obviously the $5,950. So you are going to subtract the standard deduction on this one. When you run your math, you get $29,250 for his taxable income. From there, take that new number and come up here. Here, we've got to use the tax table. So again, this is a single man, so we're using the first column. You have to move down row by row and take that percentage of every single value. So we're talking about $29,250, which is going to put us ending in the 15% bracket. But first, you have to take 10% of this bracket, then 15% of this bracket. If our salary was larger, we'd just keep moving down, but because that $29,000 is within this one, we're going to stop right here. So, you run it. 10% of $8,700 plus 15% of, this is a span. This is saying $8,701 to $35,350. Well, we don't need to go quite that far. We only need to go to $29,250. So, we're going to take, paper, come on. $29,250 minus that $8,701. You are always going to subtract the smaller from the larger just because we are not dealing with negatives. No. So, 10% is 0.1, 15% is 0.15. Bring your numbers down. I went ahead and did my subtraction here to get $20,549. Then from there, 10% of $8,700 is $870. 15% of $20,549 is $3,082.35. Add that together and you get $3,952.35. That is the federal tax owed by a single man, no dependents, whose gross income, yada, yada, yada. If we had tax credits, we would deduct that. We don't have any tax credits. So that is our final answer. And that's all for your day 1 notes. We'll pick up with day 2 tomorrow.